Right, so I'll kick off then. Hi, morning everybody. Nice to meet you. I'm Guy. I'm an investor here at Crane. My background, I spent 4 years in venture capital and 4 years in operating roles. So not just kind of one of those traditional people that have moved into VC. I've actually done the operating side as well. Most recently worked on Fido, which is one of Crane's portfolio companies in the identity verification space. And prior to that, also worked for an early stage startup called Flatfare, which was looking at open banking payments within the renting market and fintech. Flatfare was the 15th employee, and we scaled up to 85 people. We raised our Series A from Index Ventures, scaled back down after COVID hit and everybody stopped renting. So I've got a good understanding of what it's like when everything's on fire. You're still trying to understand product market fit. It's a very scrappy process, but those are some of the happiest memories of my working life. So I'm jealous that all of you get to go through that process as well. And then on Fido was slightly different, 600 people globally and 120 million ARR. So much more around scaling their go-to-market motion. So that's a bit about myself, about Crane. So we're an early stage fund. We do pre-seed and seed investments based in London, but investing all across Europe. We have quite a narrow focus from an investment perspective. So we just do enterprise software, and we specifically just focus on data and infrastructure. So when we're thinking about the stack, we wouldn't really touch kind of application layers, SaaS, or things like HR tech or CFO tools. We're really interested in developer tools, machine learning companies, anything that's AI or data first, and looking to replace legacy stacks. So we can do anything from fintech and payments infrastructure to crypto and to cybersecurity, or just traditional cloud infrastructure and software. So that's a bit about us. Tickets, we write 1 to 5 million tickets. And we tend to lead rounds and take a board seat with our companies and then work really closely with them post-investment. So we're investing out of our second fund now, which is 140 million. And we've got about 60 portfolio companies spreading from pre-seed all the way through to probably on Fido size, which is kind of Series E, Series F. So hopefully I can give some good insights as to where you are in your journey and some things that will be useful for you as part of your funding process.
Awesome. Thanks, Guy. I'm just going to ask a question about where you get your deal flow from, because we were talking a lot with Joe about that at Landscape. So how many of your deals come in via cold outreach versus kind of referrals or warm intros?
So cold outreach would probably be the minority. So I think outreach needs to be done very effectively. And as an investor, you get bombarded with a ton of just generic outreach that's not specialized. So I think the first thing is, if you are doing outreach, it's so important to understand what the fund actually does, what their thesis is. Is it a consumer fund? Is it a B2B fund? Look at their portfolio companies. Do they look similar to what you're building? Because if it's not, it's so easy to spot that it's just generic outbound. And then obviously with some of the generative AI automation now, it's getting even worse for that. So I think it's really important, if you're going to be doing outreach, do your research, find your list of companies. A warm introduction is always much better. So going onto LinkedIn, understanding if there's anyone that can introduce you to those funds, whether that's an existing founder, whether that's an angel investor, whether that's someone else that's working within the portfolio, those introductions are also really important. So I'd say probably about 70% of our investments come from inbound through referrals. So that would be with existing founders that we work with, other investors perhaps, and then I'd say 5 to 10% would be inbound cold, and then the remaining would be outbound through LinkedIn. So another good tip is, a lot of investors use Sales Navigator as a way to reach founders and startups. So even just changing your name on LinkedIn to Stealth Founder will trigger a lot of these searches that some investors are looking at. So that's a great way to get inbound for or from investors, as opposed to you having to go cold as well, if you're right at that early stage. Something to think about.
How much deal flow comes from you reaching out to founders then, rather than them coming to
you? So I would say probably about 20 to 25%.
Okay, cool.
So that's where making yourself visible on LinkedIn is really important, and that's where a lot of these funds are using tools like Sales Navigator and GitHub scraping, for example, to reach out to founders.
Yeah, you mentioned a bit about generative AI and what your investment thesis is, but is there any particular trends? I mean, it might be that, or anything else that you're particularly interested in right now at Crane?
Yeah, so I think with AI, the main thing is defensibility. So you'll find a lot of investors starting to ask these companies whether there is sustainable business model here or not. And I think this goes beyond just AI companies, but it's so important to look at the incumbents and see what they're building and what they're able to build versus what you're innovating on. So I think with solutions like, let's take insurance as an example. You can see how generative AI would be so applicable to streamlining customer support, people being able to ask what their policy documentation covers, the sales process, being able to sell insurance itself, and then obviously speeding up the claims process at the end as well. But if you're a startup and you're looking to innovate in that space, you've got to be looking at what the incumbents are already doing, because they have a huge access to data moats. So, for example, one of our investors is a company called Mass Mutual Ventures. They're a huge life insurance business. If anyone's going to be able to build a generative product in that space and white label it, it's going to be the person that has access to that data. So you as a startup have to start thinking about what makes your proposition defensible when the foundational layers themselves have become commoditized and everybody can start to access this technology and this data. So I think that's applicable for AI, but it's also very applicable for what you're building in your companies as well, how to maintain defensibility and how to maintain that moat over time.
Do you think that ties in a little bit with the founder market fit? Because if you come from the industry that you're selling into, you've got a bit more access to what you might need. And also on that, like, how important is it to have, I guess, AI engineers on the team if you're building an AI product versus having anything outsourced in that realm?
Yeah, I think AI talent is tough at the moment to get your hands on, but if you're building an AI native product, you need to be doubling down into the machine learning capabilities yourself. Depending on what your output is, if you're looking at the application layer, then you might want to question whether you need to build the infrastructure yourself. Do you need to actually have the platform to be able to launch these applications, or can you use something like an Amazon Bedrock, or something like, if you're a larger enterprise, you can use like a Palantir platform where you're accessing that infrastructure and you don't have to build it out. So those are some kind of examples of that. Around founder fit, we see a lot of this. We see either founders that have deep expertise in what they're building. We invested in a company called Silverflow, which was a novel payment processor. For the former COO of Adyen set that company up. So he's a great example of someone that has huge industry expertise and a great network within that space. But on the other hand, we invested in a company called CoMind, which was set up by a 16-year-old dropout from school who have built a novel way to test for intracranial pressure. So at the moment, you have to drill a bolt through your skull to test for that. They've come up with a way using machine learning to do that completely non-invasively. So this is a founder that doesn't have a huge amount of experience in that network, but what he's done is surrounded himself with very senior executive team members who have that experience. So he's hired someone that's been in sales at Medtronic for 12 years. He's hired chief scientists in the US who were able to support him on the machine learning side. So it doesn't necessarily mean that you have to have that experience yourself. Sometimes a fresh pair of eyes is a great opportunity to solve a new problem, but then knowing when to bring in the right people to support you, especially with that fundraising narrative, because that will go back into what I was talking about with defensibility. And you can demonstrate to investors that, you have defensibility because you have the network and the experts in this space to be able to deliver on that.
Yeah, I know this is a bit subjective and we've spoken to other investors about this before, but if you don't have the capability within the founding team, how do you feel about having an advisory board featured on a pitch deck? Do you think it's important to have those people highlighted when you're going out to pitch, or do you not really take much notice of it if you see it in a deck?
I'd probably say something quite controversial. I don't think they add a lot of value. I think they're often, it's mostly marketing. It's mostly people demonstrating their network. But obviously it depends. If you have a strong relationship with that person, maybe they're an angel investor, maybe they're an advisor, somebody that you can actually call up and talk through, or someone that's going to open doors in terms of customer referrals, then it can be really useful. But I always find it's better to leave out of the deck and just drop it into conversation as and when it's relevant, because otherwise it sometimes looks as though you're overselling it. But that could just be my preference. And I've seen, a ton of companies that have put advisory boards on there and then you question them on it and they start being a bit more shifty and it breaks down a little bit. So I think if they are strong relationships, for sure, use them as an advantage. If not, beware, because investors will probably ask you exactly what the relationship is, what the monetary relationship is, how many days are they giving you per week, per month, per year, etc., etc.
Yeah, that makes sense. Okay. The group that we've got here today have raised as a minimum 75k. The average is about 280k in family and friends money, or it might be pre-seed. They might be still raising pre-seed. It might be seed. It might be a bridge. But we want to talk about metrics. That's kind of the main focus of this week, is understanding what it is that investors want to see when they're pitching. So what does good look like to you for this kind of stage, which might have been raised a little bit of money, but are going on to raise first institutional round or kind of first round of 500K-ish. The average raise for this group actually is about £1 million. But yeah, what are you looking for in terms of demonstrating early signs of product market fit?
So I think at this stage, well, firstly, congratulations for going through the process. I know you're right at the beginning, and it's a tough slog. So even to have got to the first part of raising institutional capital, that's fantastic. And I would like to say it gets easier from here, but it's I know it's a long road, and I know it's tough sometimes. So congratulations for getting on with that. What we look for really is a quantifiable pain on the customer side. That is the most important thing. So if you start narrow and you have a quantifiable pain with your customers, that means they have a hair on fire problem, and that means there's a compelling reason to buy. So your job as a founder should be demonstrating that exists, or that you've done some work to be able to validate that with the end customers. So asking yourselves, what are the negative consequences of the customer not buying your solution? And if there are none, then perhaps you should ask yourself whether you're actually solving enough of the pain in its current form, or whether you need to iterate on that. And this pain discovery should be done with the customers themselves. So asking really nice open-ended questions like, what's led you to speak to us today? What pains, problems are you currently looking to solve? How are you solving them? How are the resources applied to that at the moment? What is the quantifiable metric that you're measuring against that pain? And therefore, how can we demonstrate a return on investment? In terms of pricing, we would always expect pricing to be kind of 1/10 of the value that you save for that particular business. So if you can quantify, you're saving $1 million, 10 million in terms of cost for the business, then you can start understanding what these ACVs, annual contract values, should look like in the long run. So I think that's the most important piece of advice, is really double click on pain discovery. Once you've got a couple ideas about what your ICP could be for that particular pain, then you can start to iterate and start to do more product development and test that in more ways. But really focusing on pain at this early stage is the most important thing.
How about, I mean, when you're talking about contract value, would you ideally like to see revenue already if someone's raising a seed round, or are you happy for it to be pre-revenue but other metrics are there?
It depends. I would love to say, they should be a couple of 100K in terms of revenue, but it really depends on the market size and the product that you're building. Some products, if it's more traditional SaaS, you'll have early cohorts, you can able to demonstrate a little bit more traction. Other things like, for example, Coma mentioned, that is completely pre-revenue product. They've got to go through FCA approval first to be able to actually demonstrate that. So they're looking at quantifying the pain versus the current incumbents to be able to then demonstrate the value and then the market share thereafter. So I think that's important. I just saw a question pop up. ACV is annual contract value. So when you're selling to enterprises, typically you're selling on either a monthly recurring or an annual recurring, and ACVs, especially with an enterprise, we kind of look for the ability to get to 6-figure, 7-figure ACVs for our target customers, which is what we look for.
And before you invest, I guess there'll be people that send you investor updates, and we would recommend founders to kind of build their investor list and start updating investors. But what kind of growth would you ideally like to see before someone even pitches you? So if they're just updating you on how they're going and growing to build a relationship early, I guess what does good look like in terms of growth? But then also, are there any other kind of green flags that make people stand out?
Yeah, so I think on the point around investing or fundraising and building those relationships, it's tough. You want to be building your product, you don't want to be speaking to investors are unfortunately a necessary evil, but it's really important to build those relationships as soon as possible. I can give you an example. There was a company called Tacto in the procurement space. Let me share a link on that. They raised a 100 million round with Sequoia, and then 3 days later they raised a 250 million valuation with Index Ventures, because they had already built those relationships up. So they were preempted, where they didn't even have to go and raise capital because they already had those existing relationships. So I think that's a really good example of not necessarily just waiting for when you're ready to fundraise to be actually building those relationships, but starting much sooner. Investors are pretty fickle. They want what they can't have. So if you're saying to them, we're not fundraising, but you're building those relationships, that's a really good way of starting to starting to develop the foundation for when you do go out to fundraise and you do want to raise capital. So I think that's really important. I think you mentioned something about what metrics we would like to see. Is that right, Purdy, in terms of what we look for?
It's kind of like speed of growth, I guess. So rather than just demonstrating that you're at a particular point, are you looking at like, oh wow, they went from X to Y to Z in the space of 2 months, 3 months, whatever it might be?
Yeah, so I think that's far more important for Series A investors. I think when there's more metrics there to demonstrate how quickly the growth is, or the retention of the cohorts, that's much more important. I think for us, it's just looking at the traction with the converting POC customers. So POC would be proof of concept, or POV, proof of value. That's where you go and you get a paid POC with an enterprise customer, and then you look to try and convert them into an annual contract value thereafter. So what we would like to see would be the growth of those conversations with potential customers. And that goes back to my point around the pain. If you've identified a pain within one particular sector, you can then grow that across multiple partners and then start to try and onboard these paid POCs. That may give you a 50K revenue for that one POC. You may be able to get slightly more. You should definitely be charging for this, by the way, as another piece of advice. Don't necessarily think about giving out free POCs. If people equate the value they're getting to the value that they're spending on the product. So if you're going to do a POC and invest that time, you should charge for it, and you should look to then establish what the pricing will be thereafter. So we would like to see the continuation of that momentum, as opposed to necessarily pure revenue itself. But depending on the stage of the investor, if it's a more Series A, Series B investor, where it's slightly later stage, they might want traditionally $1 million in revenue is when you want to be raising a Series A, and when Series A investors get quite excited. So that's a metric that sometimes investors talk to.
Yeah, okay. So outside of that, what other green flags kind of help founders stand out, either during outreach or during pitching, or kind of post pitching whilst you're going through DD?
I think explaining it in layman's terms, being able to really boil it down to its simplistic form. What are you selling? Why is it useful to the person that's buying it? Why is it different from what's currently out there in the market? So that kind of pre and post the world in terms of that transformation is really important. And how you build a long-term defensible market, that's also crucial. So just being able to distill it back to its basic form. And I know that with technical founders, that can often be quite challenging, but building with the end in mind is always really useful, and being able to put yourselves in the persona of the customer as you're speaking to investors is crucial as well. So I think that's very important.
So just making it as simple as possible. Any red flags that you've had in your experience, or you would really put you off?
Generative AI, Web3, carbon accounting companies. No, one of the biggest red flags we see is hiring a head of sales too early. So I think at the early stage, it's really important as a founder that you build out the repeatable sales motion, and that you don't bring on someone else to take that off you too early. We've seen countless examples where the founder gets to the point where they don't want to be selling and they want to be building the product. They bring on a head of sales. The motion isn't developed yet in terms of being able to scale it to other customers, and they haven't done enough pain discovery. And that's when, unfortunately, they have to part ways kind of 8 months, 12 months later, and it's a bit of a waste of time. So until you get to 2 to 3 million ARR minimum, we would expect the founder to be doing the sales discovery, being able to then create that repeatable motion. And that's something that's really important to do as well.
This came out in Joe's session just now as well. You might have caught just the end of the conversation. How do you feel about people using brokers to do fundraising on their behalf? I'm guessing it'll be similar to the founder doing the sales, the founder doing the fundraising, but do you have any different opinions?
Referrals, as I mentioned previously, are really powerful. So tapping into angel networks, tapping into early investors, that's also really important. I think brokers would be a bit of a red flag for us. It would kind of demonstrate that you aren't able to reach the investors, not necessarily you aren't able to reach them yourselves, but that you're perhaps struggling with distribution. So that could be a signaling problem. And I also don't think, at the early stage that you're raising, often you shouldn't need to have brokers doing that. You should be able to access angel networks, early stage funds. There are asset management companies that are offering investments. There are family offices that do particular investments. So there's enough capital out there without having to necessarily go to a broker. And I don't think brokers have, maybe this is a bit unfair, but particularly strong relationships with strong institutional VCs. I don't think many VCs would get their deal flow from brokers. So as a founder, that wouldn't be somewhere that I would be spending a huge amount of time. But I don't want to talk ill. If you've got a great relationship with a broker and you can raise the capital on a good valuation, then you should absolutely go for it.
Yeah. And would you say that your portfolio company are a good source of deal flow for you?
Absolutely. Yeah. We have a referral scheme with our portfolio founders. So if they come across someone within their network and they refer them to Crane, then there's also an equity kickback for them. So that's a great thing that we do.
Yeah, that's really
And
good.
also, we know that if we've invested in a very technical founder in computer vision, for example, we leverage our founders a huge amount for diligence as well. They know the market much better than we do, and they're experts in their space more than we are. So they can be a great source of referrals to other companies that they've met in the space. So I think, networking within the founder community is also super important.
With the relationship building piece, we've had another investor talk about this before, about when you start building the relationship. And obviously, there might be things that go wrong. If you start building a relationship 6 months before you want to raise, for example, and then you have to go through a pivot, or your metrics aren't as good as you're hoping that they might be, and so you're getting exposed to that in an investor update. Do you think that's useful for you to see, or do you think it would actually put you off? And I guess it's like the balance of at what point do you start building the relationship when you know that all of the news that you're going to be giving to investors is good, versus an actual transparent relationship where an investor would want to see some of the kind of negative situations and how you deal with it. What's your opinion?
Yeah, there's a book called Getting Naked, which I was reading recently by a guy called Patrick Lencioni. It's all talking about vulnerability, and being vulnerable is a really strong way of endearing yourself to other people. And I think we as a society probably build up these shells that we don't want to be seen as being vulnerable. But actually, if you're vulnerable, it shows that you can trust somebody and you can actually build a relationship on top of that. So if I saw an update that was very truthful and said, we were doing pain discovery, we thought we had our ICP customer defined, then we had to pivot because we actually realized that wasn't solving enough of the pain. And now we're going down this way in terms of our resources and our product development. That shows a founder that's acutely aware of the problem that he's trying to solve, or he or she is trying to solve, and able to pivot and listen to the market feedback. That's incredibly strong. That's a great signal. That's something that I wouldn't have seen if we only started right on day 60 as opposed to day one. So I think it's possible that you should be doing that for sure and sharing that with investors.
Yeah, and we get our founders every week when they go through the program to give us an update, and we like to have some kind of quantitative but also qualitative. So tell us any of this stuff, because it's just useful. At least you've tackled this problem now. It could come up further down the line, but you've already seen it and been able to respond to it, which could be a positive.
Yeah, there's nothing more powerful than saying, this is what we thought, this is why we were wrong, this is how we've updated our beliefs. That's iterating your product development, that's iterating your thesis on the market. That's a fantastic thing to show to investors, and you should be proud to demonstrate that as well.
How do you feel about co-founder splits, or kind of co-founders leaving within that update or before investment? I guess, like if someone said they've raised their pre-seed, now one of their co-founders wants to leave, that co-founder has a bit of equity but they want to continue on with the business, does that kind of put you off, or are you expecting that might happen?
Well, it depends on what the situation is. So usually if there's a round that's raised previously, there'll be some element of vesting or vesting shares for the co-founder. So if there isn't that, and let's say you have two founders, it's 50-50 equity ownership, and then one of them leaves, that is quite challenging to then set up a cap table that's able to be investable. That's why you have the concept of vesting shares, so that it vests over a 4 or 5 year period. And if the founder leaves, those shares are redistributed into the option pool or can be used for future investment. If that is the case, then there might be more of a cap table restructuring that you have with an investor. But again, that's a narrative, that's a conversation. It also might be an example where perhaps it's not relevant for an institutional VC, but another use of funds might be more relevant. Maybe it's a family office that would be particularly relevant at that point. Because you have to remember, when you're raising your rounds from institutional investors, certain investors have different valuation requirements or equity ownership requirements. So for us, we're a pre-seed or seed fund. We typically target 10 to 15% equity ownership. So as you're thinking about doing your equity valuation or how much you're going to be raising, you've got to make sure that there's enough space for a lead to come in and take maybe 10% of the round or 15% equity ownership, and then a smaller allocation of 5% perhaps for a follow-on or perhaps for an angel syndicate. And there's a really good, let me share an article as well. I can share it afterwards, but it's an article about valuations, because I think at this stage valuations come up a lot. How should I dilute? Why should I be thinking about pricing it? I think my advice on this is the valuations at this stage don't really matter that much. What matters much more is how much capital you need to get to the next stage. So for us, we want to get you to a strong Series A to be led by an index or a Co2 or one of these Series A funds. And we had a graduation rate of 90% from our first fund. So all we want to see is how much capital will it take you to be able to build out the product, build out the customer references, be able to get some more POCs in and demonstrate that traction. And then you can kind of work back on the back of that to calculate what the valuation of the company should be based on the requirements of the investors themselves. So this is the article. I can share it if helpful, from one of my colleagues, Anil. But basically, you would see normally a 20% dilution for the round, and then of that 20%, 50% might go to a lead, and the remaining 50% might be a follow-on or from an angel investor. So as you're speaking to investors, ask them, do you have a traditional equity ownership requirements? And when you're thinking about how much dilution you want to take as a founder, we would normally see a 20% round, but maybe it could be a 10% if you're going to go for a less institutional investor and you want to go more kind of family office angels. Or it might be slightly more if you want to go for a larger capital raise. Like in Israel, for example, they tend to do 30-35% equity rounds, but they'll raise 10 million pre-seed, and that's kind of them done for the dilution piece. Hopefully that's helpful. If anyone has any questions on that, feel free to ping me, because I know it's a topic that comes up a lot.
Yeah. If anyone does have any questions, I've got a couple more, but then we'll move on to cohort Q&A. So as with Joe's session, you can raise the hand using one of the emojis. You can ask a question to Guy directly, or you can post in the chat and we will read out your question. You actually kind of briefly alluded to it there. The success of your first fund sounds incredible. What is success to Crane? So what milestones are you looking for to return funds to your LPs, and how can the founders that are pitching you kind of prove to you that they are going to help you be successful?
So yeah, for us, the graduation rate is all we really care about. We want to see you with top tier metrics going into your Series A, so that you can command evaluation and you can basically dilute less over time. That's what we're really looking for. We take a very go-to-market approach with that. So we're looking around, as I mentioned, pain discovery, being able to articulate your sales motion, looking at your conversion from marketing qualified leads. So that's kind of your inbound motion to what we would call sales accepted opportunities. There's a ton of jargon around the sales process, but there's a really good book called The Qualified Sales Leader that I would really recommend reading. Helps you think about the buyer persona on the other end and who you're selling to, and how to start thinking about structuring your sales funnel. So that's what we would like to see much more of in terms of the evidence of the go-to-market motion that can get you to that revenue retention for the Series A.
Last question from me, which is just out of interest. When you moved from Onfido to Crane, yes, what attracted you to working in VC from being an operator?
Yeah, I miss being an operator, I have to say. As I said at the beginning, there's nothing like being in a startup and all working on the same goals and being together within a team. I think VC can often be very individualistic as opposed to that collective. I played a lot of rugby when I was growing up, so I do miss that kind of team sport atmosphere in a startup. But being on the VC side, the thing that's amazing is once you make an investment, you're working with those founders for 10 years in often cases. So when you're choosing your investors, make sure that you have that personality fit, because they are going to be the people that you want to pick up the phone to and call, or on a Sunday night or a Saturday night when you can't make payroll the next week or the next month. Those are going to be the people you want to trust and you want to have a good relationship with. An investor once described it as, I invest in companies that I can imagine myself having a pizza with at 3 a.m. With the founder. So I think it works the same way as a founder. Look for investors who you really get on with, you have a good personality fit with, and be able to ask them questions outside of the kind of traditional data gathering of fundraising. Ask what motivates them, ask what makes them tick. Get some insight in terms of how they're approaching the market, how they're approaching the problem, and what drives them as a person, and that can be really useful.
Yeah. How much attention do you pay to who you're co-investing with? So who you're sitting on the cap table with, either in that round or previous rounds?
So we tend to lead rounds, as I mentioned before. So for us, we have people that we worked with previously on different investments, but we tend not to be too focused with who else is on the round. That's more the founder's decision, and it comes down to, you know, which syndicate or which group of investors, once they start getting term sheets in, they would prefer.
Yeah. Okay, cool. I'll move on to audience Q&A. So Danny, do you want to ask first?
Hello, good afternoon, everyone. I'm Danny. Thanks, Guy. It was really interesting listening to you today, and yeah, really helpful. I do have a question. My company is called IDGO. IDGO, and I have some experience with Onfido as well. So IDGO is the UK's first double-sided proof of age, identity and contactless prepaid card. I've got a prototype here. So you've got the old proof of age and identity on the other side. As you can see, we can't print out the MasterCard, but we have all of our suppliers. I've managed to get them to, you know, because that's also part of the investment journey, is getting the suppliers to get involved, you know, people to build the tech, especially as a solo founder. My question is that when I'm raising funding and investment, previously I've gone to investors and they've asked me, do you have a team? And can you get the metrics? One of the things is I'm raising £300,000 as my first round. But one of the things is that I can't pay for a team. I have tried to attract, you know, professionals to work on the team, but I find it really challenging because they are committed to other roles. And so they're never really fully committed to IDGO. And then the other thing is with the metric side of things, because I haven't yet paid our MasterCard program manager, we can't use their logo and their, you know, the whole marketing thing, which really puts a difficulty in being able to get people to pre-sell and say that they want this card. Because if I could show them the full product, I'm sure they'd, you know, really sign up, but I wouldn't be able to do that. So therefore, I have gone to investors and tried to raise investment, as I mentioned. And my question was that, what do investors want to see on the deck? So if I'm not able to get the metrics, if I haven't been able to pull together the team, but I've got all the suppliers and work really well with them, yeah, what, you know, the 300,000 is really just for the first 10,000 accounts. I actually, if I could raise the amount that we needed to give us a real good runway, it would be 1.2 million pounds. But as I mentioned, without any metrics, without the team, without all of those things, raising 1.2 million as a solo founder, even if I do have the product, the licenses, the suppliers, investors are turning me down, because 1.2 million pounds is a lot of money for a first round, though I've seen a lot of other companies raise that. And also the percentage, the return on investment. So investors always ask, you know, what's the return on investment? As a pre-seed company, I'd probably be giving away my whole you know, shares for that amount of money that I need to raise. And so yeah, my question was, one of them is, what can I do, you know, in that position? And but the second one was really, I have the market, everything else on the deck. It's a good deck, but the financials are letting me down, in the sense of, what do investors want to see on the deck when it comes to the financials, the ROI and the proposition? You know, what is it that they want to see, and how many slides over the deck should I cover that over?
Yeah, it's a great question. Thanks for that, Danny. So I think, firstly, one piece of advice for everybody is, no one expects everything to be built already at this stage. Everyone accepts that there's going to be an element of smoke and mirrors here. So I always imagine it kind of like, you know, Wizard of Oz. Show somebody what it's going to look like. And if you're trying to say it's automated, for example, just do it manually in the background, just to be able to type it in. So you could have a wireframe just showing you what the product might look like. Then the investor can understand when it's fully built, what does the proposition actually look like, but they're not expecting all the nuts and bolts to be made originally. So that smoke and mirrors is really important. As you were talking about with the suppliers, you can say, I've got the supplier sorted. MasterCard will come, but you can show what on a slide what the full proposition or the full product would look like, and then just have an asterisk to say, this is within product development, this is expected in Q2 next year, et cetera, et cetera. So the investor can look at and see what the full proposition is without you having to say, okay, this is all built previously. So I think that's important. On the financial side, I don't think you need to have a snapshot of your P&L or your balance sheet or anything like that. I think it's much more important to show unit economics, to be able to say, okay, this is our business model, this is our pricing, this is our distribution strategy, this is how we're going to go to market. Those are the key points, and you don't necessarily have to just show exactly where you are as a screenshot in terms of your financial metrics. That will come further down the line as you start opening up the data room and people start digging into the financial model. But really, you shouldn't feel as though you have to share that. Maybe a top line, this is what our ARR is at the moment, or this is recurring revenue, or this is our monthly recurring revenue, whatever that might be, but just a few numbers. It doesn't have to be the whole balance sheet and cash flow statement.
Brilliant. Thank you so much.
No worries.
Marco.
Thank you, Guy. Very, very interesting. Okay, so I'm the founder of Configure Software, which is we've developed a solution for automated software migration, between enterprise products. So the level that we are at is essentially we have a usable, so it's actually project usable proof of concept. It doesn't look pretty and all that, but does the job. And essentially, you get a live mirroring of not just data, but features as well. So it does feature mapping and everything. So my question is, so I'm just raising now, right? I have an opportunity that is very specific with a partner that is going to be addressing one Salesforce migration from the acquisition. Essentially, they have, quite a few enterprise clients they need to migrate to their own product now. And they had a recent disastrous experience. They lost a lot of clients and all that. So Salesforce is supportive. I have a letter of intent currently only from the client, for the partner. So they intend to use my product for every deal, right? Okay. So in preparation, obviously, I want to have everything ready. So I'm raising an investment. Now, the question is, so my product is a general purpose product. Essentially, this is just a plugin, right? So the whole migration thing, everything, all the infrastructure is general purpose, but this is a specific plugin. So I need, like, at minimum, let's say 250K investment, right? But I was advised to ask more, obviously, so I have a bit more breathing space. But then I was also advised by other people to go for 2 million, because once this is done, then you have immediately all these other markets, for example, migrating between CRM solutions and all that. So you have a massive explosive growth potentially, right? But obviously that means, okay, so valuation will be higher because you include in your projections that as well, that other products. But potentially, it's a difficult thing when you're essentially pre-revenue. Okay, so it's a mature base. So I have the proof of that. I have even case studies and all that for the baseline technology that this is built on, but I don't have for this particular technology, right? So it's a, it's a tricky thing, right? So my question is, what would you recommend in such a case? Do you go ambitious or do you go minimal?
So, I mean, I guess my first question, Marco, would be, if you raise 250K just for the product development itself, how much does that give you in terms of runway for your team, and to be able to then actually, if you're going to assume fundraising is going to take you 4 to 6 months possibly into this market, if anything goes wrong on the product side, anything goes wrong on the deliverance side, and that delays the revenue, then there's going to be a cash flow squeeze. So I think that's why we advise portfolio companies to raise kind of 18 to 24 months worth of runway without any revenue. So we say, take out revenue, take out any inflowing, just look at your operating costs and what it will take you to build the product, then raise 18 to 24 months worth of runway to be able to get there. So that would be my recommendation, because otherwise you'll raise 250K, something will go wrong on the product go-to-market side, and then you'll have to go and fundraise again, and you're doing it from a position of weakness as opposed to a position of strength. If you can raise a larger amount now, saying, I'm raising for 24 months of runway, these are my POCs that I have with Salesforce and some of the other distributors, this is our initial ICP, this is our initial ideal customer profile for one particular migration pain, but I've identified 10 other pains. So once we've nailed this particular vertical, it's going to be very easy to integrate and to go to market for CRM integrations or CRM migrations, etc. So I think I would go for the larger round, but tell the big story.
Okay, so essentially you would always assume, even though now we are expecting the deal flow to start in Q1 2024, you would just assume it won't happen.
Assume it won't happen. Like worst case scenario, raise for 18 to 24 months. And then that gets you to the position again to be able to raise a strong Series A or a strong seed round later down the line.
Okay, am I allowed a follow-up question from Purdy?
Very quick one, yeah.
Okay, so the other one was, you said you wanted to bring your portfolio companies to good Series A, right? I just wanted to know what kind of growth in valuation would you consider that to be a good round, a good result, and how long should it take?
So again, it depends on how much you want to raise, and it depends on what you're building out in terms of a product. Let's say a traditional enterprise software company might want to raise a 10 million round, 10 million Series A. If they were selling kind of 20% dilution, that would be at a 50 million valuation. So the seed round might be, 3 million rounds on 15 million post money. So again, 20% dilution. So you go from 15 million valuation to 40. That would kind of be a traditional uplift. But if you're raising a 10 million Series A round, you want to be on kind of 1.2, 1.3, maybe 1.5 million ARR, growing, scaling, and being able to demonstrate that go-to-market motion and that product market fit.
Thank you.
Pleasure.
Lokesh?
Yeah, thank you. So, hi, guys. Thanks for your inputs. So I'm Lokesh. I'm the founder of iQuantum Technologies, a pure play SAP partner in the UK. We've been in business for 4 years now, and we are over 1 million in terms of revenue, and we have operations in the US as well. So last September, we commercially launched our new IP, MyIQ.ai, into the invoice automation space using artificial intelligence and machine learning, right? So the complete product development was handled or invested by the revenue generated by iQuantum. So almost over 250 grand in terms of building the product and commercially releasing it. So my question is, we wanted to go for a fundraiser. So we wanted to roll MyIQ.ai into a separate entity because that's into the product space and the services business as a separate business vertical. So from the investor standpoint, what is your kind of opinion to have the IP of us inside the main entity, iQuantum, and then go for a combined fundraise, considering the revenue generated by iQuantum and the product that we have built? Or from the investor standpoint, it will be appropriate for them to have individual interest focus from the management team to spin it out into a new entity and raise equity on the new entity. Okay, so that's my question.
Yeah, so I'm not fully familiar with the IP ownership of the company or the cap table, but my general advice would be, if you're raising an institutional round, try to make it as simple as possible. So if you are looking to raise capital for an entity, try to make sure that entity already owns the IP prior to being able to raise the round, because it just makes it much cleaner. People can look at the cap table, they can understand that, if they're going to invest a 5 million round, you're not going to have to spend 1 million of that buying out the IP from the previous entity. So I would try to clear that up. You can do it at the same part of the round if you'd like to, if that's relevant, and that's a good time to do it. But I would try to make it as simple as possible so that the cap table represents the value of the company at that moment in time.
So will that be like, say, for example, what does investors think about a services business compared to a product business? Would they be keen to invest on a services business, and then or they'll be more keen to look at a product business like a SaaS product?
I think it depends on what the investor's investment thesis is. So for us, we wouldn't do a service business. We would just do product, and we have a very narrow focus. But you need to do that as part of the discovery, asking them whether they do services business, checking out their portfolio, seeing if there's any evidence of other companies that they've invested in that have a similar profile to yourself. Fundraising is about finding the right investor for you. So looking at the market and making sure that you understand what they're looking for. And then you can tie that into your outreach and say, hey, I saw that you invested in an XYZ company that's in the services space. They're very similar to us. This is our growth profile. Would it be interesting for you to have a first call? That would be my recommendation.
Thank you.
I'm just going to take a couple of questions from the chat and then we'll go to you, Mark. So one question from Noel: should a founder avoid pitching a VC if they already have an asset that could be a direct competitor in their portfolio?
You should ask the question, because certain VCs have different approaches to this. We, for example, wouldn't invest in a competitive company if it's in the portfolio. We might introduce you to other investors, so that's why it's always worth reaching out to investors, because it's a very tight-knit community, and if something's not right for me, it might be right for somebody else that I know at another fund. So it's always worth doing that. But some investors have a consolidated approach where they take a bet on for example, account-to-account payments, and as a new theme, and they'll make 4 or 5 bets in that space. Or if you look at Sequoia, they invested in a company called LangChain, and they also invested in a company called Dust. They both do very, very similar things. They're both going to be competitive at some point, but they're taking a bet on that AI tooling infrastructure space. So it depends on the investor's tolerance for that.
And then a question from Jolie. If you have already rejected a company, would you still want to receive emails from the founders regarding their development? Would you even read the update if they sent it to you?
Yeah, so this is a really good question. I think there's a lot of emotion to this as well, because as a founder, if you get if you're not progressing with the first round, sometimes you feel as though you've been rejected or that you're not interesting. I would say that it's only ever a rejection or a pass in that moment in time. We've had companies that we've looked at 4 times that have ended up getting funded on the 4th because they've demonstrated what they've learned, how much they've grown in that period. We actually have a company coming in today that we said no 6 months ago. They went away, they addressed a lot of our concerns, and they're coming back and pitching today for a round. So even though it's hard to push away some of that emotion, try not to be so defensive, and try to encourage the investors still to look at the updates and still to keep them in the loop. And if you can demonstrate how you've transitioned, how you've developed, then it's a great opportunity to reach out and fundraise again.
Awesome. Thank you so much. Mark.
Thanks, Wendy. Hi, Guy. Thanks for the talk so far. It's very insightful. I'd love to know how you look at companies that have a pipeline for enterprise clients in the future, but at the moment, so I'm talking about my product, which is post MVP, private beta testing. We have enterprise customers on the wait list, and that's part of the vision, is to eventually sell to those, but that probably won't be for at least 12 to 24 months. How would you kind of like that vision to be sold as a founder, and how do you look at businesses that aren't kind of directly being used by enterprise customers at the moment, but their goal is to have that in 12, 24 months time?
Yeah, great question. And I think enterprise sales is very slow, long sales cycles, long procurement processes. You have to make sure that the investor you choose understands that, because it is tough. That's something that we're quite used to. So that doesn't put us off in any way. The most important thing is demonstrating and that you understand what the process looks like within those enterprise customers. So you have multi-threaded within the enterprise itself. So you don't just have one person that's your champion. You might have multiple champions. You understand who the economic buyer is. You understand who the person that ultimately has sign-off is. You understand what the legal and procurement process is yourself, and that you're aware of how that's tracking over time. A good example we have in our portfolio is a company called SeaChange. They are doing machine learning for anti-theft at checkout, and you wouldn't believe how much theft is going through Marks and Spencers and Sainsbury's. It's like 5% of their net revenue. It's like hundreds of millions a year. It's crazy. And they're selling to the likes of Walmart or the likes of Carrefour. These are long sales cycles. Their biggest mistake is that they haven't been able to maintain those connections throughout the enterprise and understand exactly where that's going, so that there's been more delays on the procurement side. So I think as you have those pipelines with those customers, just being able to do the discovery effectively and have multiple champions and be able to ask to inform investors exactly what the process looks like is really important to be transparent that way. And then, as I said earlier, having those paid POVs where you can say, okay, I'm trying to work with AstraZeneca. They've demonstrated that there's a problem here that I'm solving for them, that I've identified a current pain and there's a willingness to buy. They've demonstrated that by paying 50K, whatever it is for the POV, and it's going to take 3-4 months to convert, and they've already agreed on what the pricing looks like afterwards. So I think that then says it's not just a punt, it's a conversation that you've thought through, that you know exactly how it's progressing, and you know how it will convert into the customer later down the line.
Okay, makes sense. Thanks.
How important to you is letters of intent? Like, before you get to the point where someone's paid for a pilot or a POV, would you see kind of a letter of intent as a positive indication, or is it not enough really?
I think it's a great start that shows that you've reached out to the company and you've articulated your problem space, you've understood what the solution is. For us, we would kind of say we want more. Show us the revenue, show us the demonstration that this isn't just fluffy, it's a letter of intent. They actually are willing to spend 6 months on integration, or they're thinking about how this integrates within their existing stack. So we would ask, for a little bit more than just the letter of intent. But it's a great start. You have to start somewhere to get those conversations with these slow moving enterprises. So it's positive in that way.
Another question from the chat, which again might be a bit subjective, but what do you do about investor ghosting? So you've received an initial reply, they've looked at your deck multiple times, but not given any specific feedback. Do you continue to reach out, or just, I guess, accept that they're not interested?
Well, it's not very nice, is it? I think I would reach out until you get the feedback. Any piece of feedback is important. Just keep emailing them. They get a ton of emails a day. Just keep emailing them saying, I noticed that you hadn't come back to me on these points. These are the areas that I think you raised during the call or during the meeting. Do you have any feedbacks particularly? Or if this isn't relevant to you, please just let us know. Because again, if you're a consumer product and you're reaching out to me at Crane, it's probably not going to be relevant for me. I will still try to respond and let you know that it's not relevant. But if I don't respond at all, then you guys are just left in the lurch. So I think it's important just to, again, try not to be too defensive and emotional, and just keep hassling, keep hustling, and keep after them as well.
Thank you so much. If anyone has any last minute questions, we've got about 5 minutes left, then do raise your hand and post it in the chat. If anyone here has listened to everything you've said and thought, I think Crane is the perfect investor partner for me, what's the best next step for them? How do they reach out to you?
Yeah, so reach out to me on LinkedIn would probably be the best thing. If you're able to share a deck so I can have a look at it, that would be really useful. As I said, we do machine learning data infrastructure companies specifically for B2B enterprise. That's our area of focus. If you have any questions on fundraising more generally than that, also happy to help and just give some advice if helpful.
Thank you so much. Oh, there's a question that's literally just come in. What do you look for at the solo founder if you want to invest as an individual rather than a VC entity? Rajesh, confirm what you mean by that question, if you can take yourself off mute.
Sure thing. Thanks, Betty. So basically, I'm a solo founder, and I'm just wondering, if you are an individual, let's assume you are not from the VC end and you are an angel investor, what would you be looking at from a solo founder? And if you can give us a quick list, that would be really helpful.
Okay. Yeah, sure. I mean, solo founder, it's going to be team experience. Do they understand the problem that they're solving? Can they articulate that this is the reason as to why it needs to be solved in this way? Do they understand how to be able to go to market and get enterprise customers actually signing up for this? Can I reference them? So that's also really important. If they know people within your network, I imagine they will reach out to them and understand how you performed in previous roles. And then do the timings and the dynamics make sense as well? But they will want to meet you. They want to have a conversation face to face. But a lot of these angel investors will invest in topics or areas that they're particularly interested in. So, a colleague of mine is a guy called Freddie Kelly from Credit Kudos, which is an open banking product. He now invests kind of specifically around finance and cybersecurity because that's an area of interest to him. So I think that's also important is, are you solving an area of interest for that particular person? We saw a founder the other day who's building kind of the AI for Vercel. Vercel is a way of deploying front-end applications. He spoke to the head of AI at Vercel and the founder of Vercel to be an angel investor because he knows that they're particularly interested in that area. So I think that's also important. Do they take a personal interest in what you're building?
Yeah.
Perfect. Thank you so much, Guy.
Pleasure.
Jolie, do you have a quick last minute question?
Yeah, I do. It's actually on IP. So I'm just we have done an IP audit and has identified some potential patent that we can apply, but of course that need a lot of time and a lot of money, and just which we don't have. So just wonder at our stage, kind of like when there are a lot of investors, they are interested in IP, but we have identified, but we don't have the application in place. What is the best way to sell this? And another thing is also confidentiality, because our IP audit has said to us that before you apply, don't disclose anything, which is of course counterproductive. So I just wonder from your investors' perspective, what's your your advice on this? Thank you.
Oh, that's a really good question. And I wish I'd be able to help more, but we don't really invest in IP first businesses. So I think it's tough for me to give too much insight, especially with software. Nothing's really patent protected. So yeah, I'm gonna have to unfortunately not be able to help on that. I think the main thing would be demonstrate, I guess, what the market looks like, that you've done an assessment of the existing IP out there, and you understand how your patents will convert later down the line and what protection that will give you compared to the market. So again, kind of the narrowing down on your niche, on your area of defensibility. But I'm not super close to kind of patent investing myself. I can ask a couple of colleagues if that's helpful, but unfortunately that's not an area I'm particularly strong at.
That's great, thank you. And
Oh,
thank you, Danny, for the message on the chat. Sorry.
I was going to say, but we can ask some more investors as well that we know and see if we can find an answer for you on that. Guy, thank you so much for your time. We'll let you go, and then we'll just spend 2 minutes kind of wrapping up expectations for the rest of the program and weekly updates and what you need to do next. So thank you, Guy.
Great to meet you all. Thanks a lot. Best of luck with everything.
Thank you.